Welcome to the Econophysics introduction with respect to options investing. Note, some of the terms employed within this discussion might initially be unfamiliar. Not to worry. Later discussions will expand on this discussion and explain all terms clearly. This is also true for any formulas and calculations that will become part of the discussion. The purpose of this introduction is to provide a blueprint or roadmap for future discussions. Most of the information in this introduction is information regurgitated from Wikipedia or some respective investment platform. The link to the original discussion is usually shown near the text. Sometimes comments are added to help clarify the discussion text. With this understanding, let us begin. The financial risk pyramid illustrates the trade-off between risk and return for a number of savings and investing tools. As one moves towards the top of the pyramid with both risk and income returns increase. As stated in the title, the focus of this discussion is options investments. However, options require an underlying asset. In this case, for this introduction, that asset is a stock. Since there is no direct purchase of the stock, there is no risk and no return with respect to the stock. Nonetheless, upon purchasing an options contract on the stock as the underlying asset, the risk of loss increases. Depending on the structure of the options contract, there can also be an increased probability of return or income gains above cost. In simple terms, risk is the probability of something bad happening. Risk involves uncertainty about the effects/implications of an activity with respect to something that humans value, such as health, well-being, wealth, property, or the environment, often focusing on negative, undesirable consequences. Return on investment, ROI, or return on cost, ROC, is a ratio between net income over a period and investment, cost resulting from an investment of some resources at a point in time. A high ROI means an investment gains compare favorably to its costs. Notice there's a double line drawn through return on costs. This is because ROC becomes employed in the discussion in a different capacity than that of return. Therefore, when speaking of returns, the discussion will always employ ROI. Financial risk is any of various types of risks associated with financing, including financial transactions that include company loans and risk of default. Often it is understood to include only downside risks, meaning the potential for financial loss and uncertainty about its extent. A science has evolved around managing market and financial risks under the general title of modern portfolio theory, initiated by Dr. Harry Markowitz in 1952 with his article, Portfolio Selection. In modern portfolio theory, the variance or standard deviation of a portfolio is used as the definition of risk. Types of risks include market risk, model risk, credit risk, liquidity risk, valuation risk, and operational risk. There are also other risks such as reputational risks, legal risks, and IT risks. Additionally, there are concepts like diversification and hedging, which are strategies for reducing risk. Let us take a few minutes to discuss the different types of risk. Market risk is the risk of losses in positions arising from movements in market variables like prices and volatility. In finance, model risk is the risk of loss resulting from using insufficiently accurate models to make decisions, originally and frequently in the context of evaluating financial securities. Going beyond this introduction into more advanced modeling, there would be calculations where knowing the model risk is of great value. Credit risk is the possibility of losing a lender's hold due to a risk of default on a debt that may arise from a debtor failing to make required payments. Liquidity risk is the financial risk that for a certain period of time, a given financial asset, security, or commodity cannot be traded quickly enough in the market without impacting the market price. Valuation risk is the risk that an entity suffers a loss when trading an asset or liability due to a difference between the accounting value and the price effectively obtained in the trade. Operational risk is the risk of losses caused by flawed or failed processes, policies, systems, or events that disrupt business operations. In finance, diversification is the process of allocating capital in a way that reduces the exposure to any particular asset or risk. A common path towards diversification is to reduce risk or volatility by investing in a variety of assets. A hedge is an investment position intended to offset potential losses or gains that may be incurred by a companion investment. A hedge can be constructed from many types of financial instruments, including stocks, exchange-traded funds, insurance, forward contracts, swaps, options, gambles, many types of over-the-counter and derivative products, and future contracts. Mathematical optimization, or mathematical programming, is a selection of a best element with regard to some criterion from some set of available alternatives. It is generally divided into two subfields: discrete optimization and continuous optimization. Optimization problems of sort arise in all qualitative disciplines, from computer science and engineering to operations research and economics, and the development of solution methods has been of interest in mathematics for centuries. In the more general approach, an optimization problem consists of maximizing or minimizing a real function by systematically choosing input values from within an allowed set and computing the values of the function. The generalization of optimization theory and techniques to other formulations constitutes a large area of applied mathematics. More generally, optimization includes finding best available values of some objective function given a defined domain or input, including a variety of different types of objective functions and different types of domains. Internal control, as defined by accounting and auditing, is a process to assure organizational objectives through operational effectiveness and efficiency, reliable financial reporting, and compliance with laws, regulations, and policies. A broad concept, internal control involves everything that controls risk to the organization. Control theory is a field of controlled engineering and applied mathematics that deals with control of dynamical systems in engineered processes and machines. The objective is to develop a model or algorithm governing the application of systems inputs to drive the systems to a desired state, while minimizing any delay, overshoot, or steady-state error and ensuring the level of control stability, often with the aim to achieve a degree of optimality. For investing purposes, control comes from a mathematical program called an algorithm. One incorporates algorithms into investment models to help reduce risk and increase returns. A major application of mathematical control theory is in the general theory of feedback systems, where control theory is useful whenever feedback occurs. Thus, control theory has applications in life sciences, computer engineering, sociology, and operations research. In artificial intelligence, feedback systems usually involve neural networks, which are part of the deep learning model explained later. Broadly speaking, a risk assessment is the combined effort of 1. Identifying and analyzing potential events that may negatively impact individuals, assets, and/or the environment, and 2. Making judgments on the tolerability of the risks on the basis of a risk analysis while considering influencing factors. In economics and finance, risk aversion is the tendency of people to prefer outcomes with low uncertainty to those outcomes with high uncertainty, even if the average outcome of the latter is equal to or higher in monetary value than the more certain outcome. Risk aversion explains the inclination to agree to a situation with a more predictable but possibly lower payoff rather than another situation with a highly unpredictable but possibly higher payoff. For example, a risk-averse investor might choose to put their money into a bank account with a low but guaranteed interest rate rather than into a stock that may have high expected returns but also involves a chance of losing value. Risk analysis is a technique used to identify and assess factors that may jeopardize the success of a project or achieving a goal. This technique also helps to define preventive measures to reduce the probability of these factors occurring and identify countermeasures to successfully deal with these constraints when they develop to avert possible negative effects on the competitiveness of the company. One of the more popular methods to perform a risk analysis in the computer field is called facilitated risk analysis process. Statistical risk is a quantification of a situation's risk using statistical methods. These methods can be used to estimate a probability distribution for the outcome of a specific variable, or at least one or more key parameters of that distribution. And from that estimated distribution, a risk function can be used to obtain a single non-negative number representing a particular conception of the risks of the situation. Risk management is the identification, evaluation, and prioritization of risks followed by coordinated and economical application of resources to minimize, monitor, and control the probability or impact of unfortunate events or to maximize the realization of opportunities. Risk management is defined in ISO 31000 as the effect of uncertainty on objectives. This is a global list of the top 10 stock exchanges. There are 16 stock exchanges in the world that have market capitalization of over $1 trillion each. They are sometimes referred to as the $1 trillion club. These exchanges accounted for 87% of global market capitalization in 2016. Some exchanges do include companies from outside the country where the exchange is located. A stock market, equity market, or share market is the aggregation of buyers and sellers of stocks, also called shares, which represents ownership claims on businesses. These may include securities listed on a public stock exchange, as well as stock that is only traded privately, such as shares of private companies which are sold to investors through equity crowdfunding platforms, where an investment is usually made with an investment strategy in mind. Equity crowdfunding is the online offering of private company securities to a group of people for investment and therefore is part of the capital markets. Because equity crowdfunding involves investment into a commercial enterprise, it is often subject to securities and financial regulation. Equity crowdfunding is also referred to as crowd investing, investment crowdfunding, or crowd equity. In finance, stock consists of all shares by which ownership of a corporation or company is divided. Especially in American English, the word stocks is also used to refer to shares. A single share of the stock means fractional ownership of the corporation in proportion to the total number of shares. A stock derivative is any financial instrument for which the underlying asset is the price of an equity. Futures and options are the main types of derivatives on stocks. The underlying security may be a stock index or an individual firm's stock. In finance, the capital asset pricing model is a model used to determine the theoretically appropriate required rate of return of an asset to make decisions about adding assets to a well-diversified portfolio. The market reward to risk ratio is effectively the market risk premium. And by rearranging the above equation and solving for E with respect to R sub I, we obtain the capital asset pricing model. Alpha is a measure of the active return on an investment, the performance of that investment compared with a suitable market index. An alpha of 1% means the return on investment over a selected period of time was 1% better than the market during that same period. A negative alpha means the investment underperformed the market. The alpha coefficient is a parameter in the single index model. It is the intercept of the security characteristic line, that is, the coefficient of the constant in a market model regression. In finance, the beta or market beta or beta coefficient is a measure of how an individual asset moves when the overall stock market increases or decreases. Thus, beta is a useful measure of the contribution of an individual asset to the risks of the market portfolio when it is added in small quantity. The market beta of an asset I observed on T occasions is defined by a linear regression of the rate of return of asset I on the rate of return of the stock market index M. Later discussions will carefully explain the capital asset pricing models, alpha and beta. In finance, an option is a contract which conveys to its owner, the holder, the right to, but not the obligation, to buy or sell a specific quantity of an underlying asset at a specified strike price on or before a specified date, depending on the style of the option. In mathematical finance, the Greeks are parameters representing the sensitivity of the price of a derivative such as options to a change in underlying parameters on which the value of an instrument or portfolio of financial instruments depend. Delta represents the sensitivity of an option's price to changes in the value of the underlying security. Theta represents the rate of time decay of an option. Gamma represents the rate of change of delta relative to the change of the price of the underlying security. Vega represents an option's sensitivity to volatility. Rho represents how sensitive the price of an option is relative to interest rates. Later discussions will demonstrate how to manually calculate the Greeks, while other discussions will demonstrate how to incorporate the Greeks into a financial model. A candlestick chart is a style of financial chart used to describe price movements of a security, derivative, or currency. It is similar to a bar chart in that each candlestick represents all four important pieces of information for that day: open and close in the thick body, high and low in the candle wick. Being densely packed with information, it tends to represent trading patterns over short periods of time, often a few days or a few trading sessions. In statistics, a box plot is a method for graphically demonstrating the locality, spread, and skewness groups of numerical data through their quantiles. In addition to the box, there can be lines called whiskers extending from the box indicating variability outside the upper and lower quantiles. Thus, the box plot is also termed box and whiskers plot or box and whiskers diagram. Note the similarity between the box plot and candlestick chart. Outliers that differ significantly from the rest of the dataset may be plotted as individual points beyond the whiskers on the box plot. Box plots are non-parametric. They display variation in samples of a statistical population without making any assumptions of the underlying statistical distribution. The spacing in each subsection of the box plot indicates the degree of dispersion or spread and skewness of the data, which are usually described using the 5-number summary. Box plots can be drawn either horizontally or vertically. Option strategies are the simultaneous and often mixed buying or selling of one or more options that differ in one or more of the options variables. Call options, simply known as calls, gives the buyer the right to buy a particular stock at that option's strike price. Opposite to that are put options, simply known as puts, which gives the buyer the right to sell a particular option at the option's strike price. This is often done to gain exposure to a specific type of opportunity or risk while eliminating other risks as part of the trading strategy. A very straightforward strategy might simply be the buying or selling of a single option. However, option strategies often refer to a combination of simultaneous buying and/or selling of options. Option strategies are the bread and butter of options investing. Later discussions will invest a significant amount of time in developing option strategies from the most basic to the very advanced. GeoGebra, a portmanteau of geometry and algebra, is an interactive geometry, algebra, statistics, and calculus application intended for learning and teaching mathematics and science from primary school to university level. Maximum is a system for the manipulation of symbolic and numerical expressions, including differentiation, integration, Taylor series, Laplace transformation, ordinary differential equations, a system of linear equations, polynomials, sets, lists, vectors, matrices, and tensors. Deep learning is part of a broader family of machine learning methods based on artificial neural networks with representation learning. Learning can be supervised, semi-supervised, or unsupervised. ChatGPT, or Chat Generative Pre-trained Transformer, is a chat box developed by OpenAI and launched in November 2022. It is built on top of OpenAI's GPT-3 family of language models and has been fine-tuned an approach to transfer learning using both supervised and reinforcement learning techniques. At some point, the discussion will incorporate these math and programming tools to help build advanced, possibly automated option strategies. Automated investing is an advanced topic of discussion within its own right. There are two main investment platforms highlighted in this introduction: Thinkorswim and Robinhood. The selection of these two investment platforms does not mean they are the only ones or even the most preferred. For example, more advanced and self-reliant traders might prefer the TradingView platform featuring TradeStation. Later discussions will explain how to set up an account and take advantage of a particular platform and explain why one might prefer one platform over another for a specific task. The building to the left is the new headquarters for the CBOE. To the right is the old building where the trading floor is still housed. The Chicago Board Options Exchange, CBOE, located at 433 West Van Buren Street in Chicago, which is the old building, is the largest U.S. option exchange with an annual trading volume of around $1.27 billion at the end of 2014. CBOE offers options on over 2,200 companies, 22 stock indices, and 140 exchange-traded funds, ETFs. This concludes the introduction to options investing. Study hard and prepare for the next chapter of this journey.